Interest rates, housing prices, sticky inflation. Look, there's just a ton of noise out there right now. Welcome to This Explainer. Today, we're basically stepping into the role of your trusted advisor. We're going to investigate some current economic signals to help you cut right through all that noise so you can make wise, long-term real estate decisions without getting caught up in the hype. All right, let's dive right in. So we're kicking off our investigation with a really vital observation. Over the past few weeks, economists, investors, and the financial markets have all started asking some noticeably tougher questions. I mean, we're seeing headlines about everything from bond markets to labor statistics. And, at first glance, they might seem like totally separate stories, but they really aren't. They're all essentially asking the exact same question. Has something fundamentally changed beneath the surface of the economy? We aren't here to play a guessing game about interest rates or predict a recession. We're just here to connect the dots. To keep things simple, here's our roadmap for This Explainer. 1. Beneath the economic surface. 2. Forces pushing rates up. 3. Forces pulling rates down. 4. Credit, AI, and uncertainty. And finally, 5. The slow grind economy. All right, part 1. Beneath the economic surface. To really get a grip on what's going on, we first have to understand that the current economy is absolutely not a single unified moving object. It's more like it's being pulled in multiple, often competing directions at the exact same time. Right now, investors are absolutely obsessing over these surface-level observations. For instance, the 30-year Treasury bond has been pushing past the 4.5% mark, hitting levels we literally haven't seen in years. On top of that, we've got all this uncertainty swirling around global energy prices. There are growing questions about just how strong the labor market actually is. And, of course, those continued, nagging concerns about inflation hovering stubbornly just above targets. These are verified facts happening in the real world right now. And while they might feel like scattered puzzle pieces, they are deeply and intimately connected. Moving right along to part 2, forces pushing rates up. Let's trace the cause and effect of these competing forces, and we're going to start right in the bond market. You've probably heard folks talking about the 30-year Treasury bond and maybe wondered, why is this suddenly front-page news? Well, before we get bogged down in a bunch of financial jargon, it's crucial to understand what this actually is and why it matters to you. At its core, it's basically a massive 3-decade bet with the U.S. government on future inflation, economic growth, and overall risk. So the key takeaway here is this. Investors are currently demanding much higher returns before they're willing to lock up their cash for decades. The bond market is always trying to price out risk, and right now, it sees enough risk on the horizon that it's demanding a pretty hefty premium. And here's exactly why they're seeing that risk. It's a chain reaction. Actually, scratch that. It's more like a giant domino effect. When global energy prices rise, say because of some geopolitical event, transportation instantly becomes more expensive. Businesses face higher costs. That drives up inflation expectations. Higher inflation expectations push up treasury yields because investors suddenly need a better return just to beat inflation. And guess what? Those rising yields directly push up mortgage rates. Higher mortgage rates mean higher monthly payments, reduced affordability, and a sudden drop in buyer confidence. This whole sequence shows exactly how massive global events cascade all the way down to impact your local housing affordability. But wait, alongside that sticky inflation, we've got some other massive upward pressures compounding on rates. First, the U.S. government has racked up significant debt, and as older debt matures, they have to refinance it at today's much higher rates. Then you've got global capital flows, basically massive amounts of money moving around the globe searching for the best return. A great example is the highly discussed Japanese carry trade. And of course, there's the Federal Reserve. Officials are keeping the door wide open to holding rates higher if inflation doesn't cool off. Markets react instantly to what they think the Fed might do next. So you take all these compounding global and national factors, and they create this incredibly powerful force pushing long-term interest rates up. Which brings us to part 3, forces pulling rates down. Now, that's really only half the story. Just look at this economic tug-of-war. On one side, we had the forces we just talked about, stubborn inflation and aggressive government borrowing pushing rates up. But on the exact opposite side, we've got a cooling labor market, weaker than forecast job reports, and downward employment revisions acting as a massive heavy anchor, pulling rates back down. We're not looking at a market moving cleanly in one direction here. It's caught in a massive standoff. So why exactly is this downward pull so incredibly strong? Well, because employment drives pretty much everything else in our economy. Think about it. When people have secure jobs, they spend money. When businesses are confident, they hire. But the moment hiring slows down, it triggers another domino effect. Consumer confidence wavers, wallets snap shut, and housing activity completely stalls. Because jobs are the true engine of the economy, this recent weaker hiring data is a massive piece of the puzzle. It strongly indicates a distinct loss of momentum. All right, moving into part 4, credit, AI, and uncertainty. Beyond inflation and labor, we've got two critical wildcards actively reshaping the financial landscape right this second. And honestly, they do not get talked about nearly enough. First up, private credit and commercial real estate. Over the past few years, a tremendous amount of cash flowed into commercial real estate back when rates were dirt cheap. Well, now those loans are coming due and they have to be refinanced in a much, much higher rate environment. Some are going to be totally fine, others are really going to struggle. And that stress ripples aggressively through lenders and local economies. Second wildcard, artificial intelligence. AI isn't just replacing workers. It's fundamentally modernizing what work even looks like. It's eliminating certain roles, creating entirely new ones out of thin air, and dramatically shifting the exact skills employers value. When you mix these two things together, they add unprecedented layers of disruption and uncertainty to the whole economy. And finally, part 5, the slow grind economy. Okay, let's pull all these threads together into a cohesive working thesis. After weighing the bond market, the labor stats, and those big wildcards we just covered, here is our professional interpretation of the data. We are absolutely not looking at an economy that is clearly booming. But on the flip side, we're also not looking at one that is completely falling apart. The thesis here is that we're in a slow grind economy. Higher long-term interest rates could stick around way longer than expected because of those inflation risks, but at the same time, the economy is showing just enough signs of slowing down that it's really hard to justify even tighter policies. So we are quite literally just grinding slowly through these competing pressures. To be completely intellectually honest with you, anyone who claims they know exactly what's going to happen next, they're probably trying to sell you something. We could absolutely take path 1. Inflation falls faster than expected. Interest rates gradually taper off, and the housing market gets some real momentum back. Or we could veer down path 2. The economy weakens further, causing some very real, tangible stress in employment and commercial credit before things finally get better. Or, we might just continue this slow grind. The economy always moves in cycles, and today's cycle just happens to have its own deeply unique catalysts. So, putting on my trusted advisor hat for a second, the absolute most important lesson I can offer you is this. Wise decisions come from understanding today's conditions rather than wishing for yesterday's. Look, you just cannot base your family's financial future or your real estate goals on how amazing the market looked back in 2021. That's over. You have to evaluate the current risk, look for the highest and best use of your opportunities right now, and base your actions firmly on the reality of today's evidence. So let's wrap up with one final thought to help you apply all of this. Now that you actually understand the underlying forces pushing and pulling the economy, from treasury yields all the way to cooling labor markets, how does this actually apply to your life? What hidden risks have you maybe not considered? And what opportunities are you completely overlooking just because you've been reacting to loud, flashy headlines instead of the underlying data? In a slow grind economy, patience and evidence are absolutely your best assets. Thoughtful decisions come from following that evidence. So, based on what we've investigated today, what move are you going to make next? Thanks so much for joining us for this explainer, and we'll catch you next time.